How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and retiresharp.com. Today's topic, I want to discuss with you, how does a retirement annuity work? So with annuities in general, there's some good things about them. There's some horrible things about them. So first, I want to explain to you how an annuity works, how a generic concept of annuity works, and then when somebody could leverage a type of annuity for retirement, specifically for a type of retirement income play or a safe, consistent retirement accumulation play, and then what are problems that individuals fall victim to when trying to leverage that strategy, expecting something else that is just truly not there, like when you're talking about income rider guarantees or guaranteed, 7% or 8%, what's kind of some of the scams out there and how to deviate or kind of read through the BS, that you might have been pitched before. So I want this to be very, very educational, kind of show you how it works, show you the negatives to annuities, show you the positives to annuities, and then show you actual examples of saying, okay, in this person's situation, an annuity worked really well. It fit like a perfect puzzle piece. With another situation, utilizing an annuity was absolutely horrible, and now this person's going to be really, really pissed off. So it's kind of a lot of these examples and a lot of these situations are just from the volume that calls into the agency. So individuals that say, hey, I got set up into this thing, 3, 4, 5, 6 years ago, whatever that case might be, and they didn't really understand how it worked, and then that agent is no longer able to be found. So therefore, someone would call in my agency to help kind of break down and educate them a little bit further. So please take out a pad and pen and take down some notes. At any point in time you're interested in hearing more information or trying to figure out your situation, feel free to give our 1-800 number a call. It's 1-800-566-1002, and we'll be sure to help you out the best way that we can. So for starters, an annuity is, I want you to think of this as the opposite of life insurance. And what I mean by that is individuals, they purchase life insurance primarily as a death benefit, or many times specifically as a death benefit play. Meaning that if, let's say, you have an individual that is the breadwinner of their family and they're going to work, each and every day, each and every year, they're bringing in X amount of income to their loved ones, to their beneficiaries, to their dependents. So let's say if somebody's making $100,000 in a given year, and that person was to, unfortunately, and they understand that they were going to be working until, let's say, they're age 65, and this person is, currently age 35, well, they say, okay, they have 30 more years of work, of income of $100,000 that's going to their family, and therefore that income is going to be paying for the different expenses for that family. So you could say, okay, well, you basically take 30 and multiply that by $100,000. So that, death benefit could essentially be comprised of like $3 million that somebody would purchase as a life insurance policy. Of saying, okay, they want to make sure, God forbid, if that breadwinner passes away, that the family is unhinged. Basically, they could still be living their life, going forward. So that's just an income play on a death benefit side. The concept that I'm trying to help you understand is life insurance prevents an individual from dying too soon. If this person passed away before they retired, before the kids were moved out of the house, before a whole slew of different variables in there, that's what this individual is paying premium dollars to an insurance company, and the insurance company is therefore, kind of think of it like an invisible umbrella over this insured's head. And this is an absolutely horrible illustration, but I'm going to keep it anyway, because I love the comments of how people bash my handwriting on these videos. But what this essentially says is, okay, $3 million is a death benefit waiting there. If this person had like a 30-year term life insurance policy and they passed away, let's say at age 50, well then $3 million is going to go lump sum, to their beneficiaries tax-free. So it's the opposite of that. So if we understand that life insurance protects this individual from passing away too soon, and their beneficiaries are going to be receiving these lump sums, in this hypothetical example, $3 million, well then they're covered in case they were to pass away before that standpoint, before that actual retirement age, or whatever the age is that they set up for their goals. So when we're looking at a retirement annuity, and let's say we're talking specifically about the income play, it is the opposite of that life insurance. So what an annuity is leveraged is to protect an individual from living too long. So if you have that standpoint of, okay, this person's 65 years old and they now have certain expenses from their retirement years, and they project that they're going to live until, let's say, age 95, so basically a 30-year time frame. If someone goes and has, let's say, $1 million, and they decide, okay, they want to pull out $50,000 per year to, suffice whatever their expenses are. Well, we understand if this was like a bucket of money, and they were taking out $50,000, they would have exhausted these monies by age 85. They would have no more monies left in that $1 million bucket. So what an annuity could do is, or if this person's living till age 95, projected to live to age 95, obviously they're falling short of that income goal by 10 years. So an annuity, what happens is it's as if you're purchasing a type of insurance on the monies. You're basically leveraging an insurance company. You're taking a lump sum of dollars, placing it in with an insurance company, and that insurance company is providing you a lifetime income stream on either a monthly basis or annual basis off of that income. So you could essentially leverage and say, okay, in this hypothetical example, let's say this person's 65 years old, and then that's when they purchase their annuity, for $1 million. Well, maybe the insurance company could pay them $50,000 per year until the day that they pass away. So let's say if they keep, this person's receiving $50,000, and all of a sudden they pass away at age 75, well, whatever's remaining in that bucket could be left over to their beneficiaries. Let's say if this person, is living and all of a sudden they're age 90, well, they would have been able to have an additional 5 years of pure monies, pure income, because their break-even point was at 85. Let's say if they live to age 95, it's going to be that much sweeter, much better of a deal to basically leverage that properly. Let's say if this person lives to 105 years old. Well, now they're having 20 years of profit, of 20 years of more income than what they projected they were going to live for, of $50,000. So the insurance company is essentially putting themselves on the hook to say, yes, we're going to pay whatever that income amount is at contract inception, because you gave us a lump sum. We're going to pay you these these types of income amounts on either a monthly basis, quarterly basis, semi-annual, or annual basis. So what I just described was something known as an immediate annuity, which I typically don't like, just because of kind of how the payouts work. They leverage something known as annuitization, which gives a lot of control to the insurance company themselves. I like using income riders. I like using different things that allow the individual to have a lot of control and basically cherry pick what the best contract is, and kind of mold the best offerings together, so it's stepping up in a type of laddering basis. And I'll explain that to you on the off of the actual example. But to kind of piggyback off of that, immediate concept is something known as deferred retirement annuity. So let's say if we have that individual is looking to retire at age 65, and we're projecting that they're going to pass away by the time they're age 95, and they understand, let's say this person's 60 years old right now, and they have 5 years until retirement, but they need $50,000 of additional monies from their retirement savings. Well, you could go and place dollars into a deferred annuity. So what that does is the insurance company gives you a larger benefit to say, if you place your dollars with them by the time 5 years short, or 3 years short, or 10 years short, whatever that is, they're able to defer what that guarantee is and then say, okay, we'll provide you $50,000. So instead of giving $1 million at age 60 to receive $50,000 at age 65, maybe it might cost this individual $750,000 or $500,000 at age 60, to say, okay, at age 65, they're going to be able to trigger the income spigot, and then that's essentially what's going to be going to them, for the rest of their life. So what this does is it's able to save the individual thousands of dollars by just leveraging the amount of years that they're placing it in there. And this is where you could have the different income riders and the best deferred related contracts that work really well with one another. And then you could have, $50,000 get triggered at age 65. You could have step-ups in income of an additional $2,000 to help combat inflation. And there's a whole slew of different things to make sure that it's sufficing what your income goal is, what your expenses are. So as long as your income is always above your expenses, you're going to be satisfied, you're going to be confident in retirement, and this is not going to be hindered with downward market losses and fees and different things like that that could entirely liquidate retirement accounts. So what I mean by that is, like with a typical scenario, there's a concept known as reverse dollar cost averaging, and this has resulted in millions of baby boomers and seniors and retirees outliving their retirement savings. Because it's not as simple as just saying, okay, I'm just going to take a fixed dollar amount from my account, and hopefully I'm not going to pass away before that time frame. What usually happens is individuals that have accumulated those dollars, they might have accumulated it in, let's say, a traditional 401k employer-sponsored type retirement plan. Well, the way on how a 401k account grows is it goes by contributions that you're making into the plan and then also rate of return. So this contribution, that's controlled by obviously the individual. The more you contribute into a type of 401k or retirement related account, the more dollars that are going in here. What a lot of individuals don't really focus on is this rate of return side. And this is where it could be a retirement disaster, because with a 401k, you typically have anywhere between 10 to about 25 different funding options to choose. So these are essentially eggs in your basket to choose from. If you're going and let's say out of these 25 funds, you choose 5 different options and they're correlated to the stock market or the bond market or real estate or commodities, whatever that case might be. Let's say if it is really heavily weighted towards the stock market performance, well, whenever the stock market's going up, you're going to receive a positive interest credit into your 401k account. So it's going to be the combination of the contributions and rate of return, which is going to give you a larger bucket at the end of the day, at the end of the year. Well, what happens if the opposite occurs? If that rate of return comes back negative, like a 2001, like a 2008, and you're not only receiving what that negative is, which could be essentially like slicing the bucket in half. Like an example, in 2008, you had seniors that were retiring. They had $500,000 in their 401k account, and they got hit with a 50% loss in that year. So therefore, starting the next year, they were walking into the year with $250,000. That's if they didn't even take out any money. What reverse dollar cost averaging does is it shows you what the negatives could be with certain retirement accounts, essentially holes within those accounts, and then also when you start pulling out those monies, it's the power of compound interest, what Albert Einstein, called the eighth wonder of the world, the power of compound interest. Rather than having that work for you, it's actually working against you. So let's say if you took your 401k monies and you put that into an IRA and you went over with some financial advisor and you're still sitting in different sorts of mutual funds, expensive related, really expensive accounts, you might be charged 1% in mutual fund related fee, a 1% in advisor fee, and that's being very conservative, by the way. Let's say if your account drops 10% in a given year and you decide to take out 5% from your account. So if somebody has $1 million and they say, okay, I need $50,000 of income to live off of. I'm going to take out 50 grand this year, but I ended up getting hit with a $100,000 loss. I ended up paying fees of $10,000 to an advisor, $10,000 to the mutual fund related company. This person would have walked into the year with $1 million. They would have only pulled out $50,000, but they would have actually ended up losing minus $170,000 from their portfolio, meaning that they walked into the year with $1 million, they took out $50,000, and their new account value is sitting at $830,000. So essentially what happens is if you're trying to take out $50,000 the next year, it's going to be off of a larger percentage off of this overall bucket. You're still susceptible to potential downward market losses. You're still susceptible to these fees. Kind of think of them as these little holes coming out. So essentially this compound interest could really destroy that retirement account. And when it destroys it, what happens? You have no more money left to pull from. You would have outlived your retirement savings, and now you just have to rely on Social Security income, or you might have to go back to work in your 70s and your 80s, at that point in time. And this is very realistic, whether you've seen it yourself or you've had, family members or friends or whatever that is. That's a very realistic scenario because this reverse dollar cost averaging effect could be very real on retirement accounts. So as much as an annuity can be a solution in that situation, unfortunately, you have a lot of marketing. You have something that I call the smoke and mirrors through insurance companies, that they have a lot of bullshit out there. Excuse my language. But it's just the truth. I'd say over 90% of companies or contracts are really for the benefit of the insurance company. But you do have anywhere between 5 to 10% of contracts could be really ideal for a specific situation. So like with my independent agency, we represent thousands of different combinations and strategies and contracts all throughout the nation. So it really depends upon which state you're in, depends upon what your situation is. But we try to provide non-biased information. So we're trying to say, okay, well, if you're giving X amount of thousands of dollars, let's say if your goal was $50,000 and you have company A that says, if you go and place 500 grand into an annuity, they could provide you 50 grand of income. That's going to suffice what your goal is. Or you have company B that says if you put 700,000 in there, we'll give you 50 grand. Or company C that says if you put 950 with our account, it's going to provide you $50,000. Why would you even look towards company B and company C if you're able to save hundreds of thousands of dollars of money in your pocket that you don't have to place into an annuity to get you to your finish line, to get you to that destination successfully? Now you could add onto your emergency funds, you could add onto your inflation protection, different things such as that. So as good as annuities can be, they could be complete disasters, and there's a lot of shitty ones out there. So that's where you just have to be mindful of it and really understand, okay, are you getting set up in the right one? And why would you go to second, third, fourth, or even 12th, 15th place? What we see a lot of times is individuals saying, hey, I'm interested in this annuity. I have this advisor that basically pitched it to me, and that's exactly what they did. They tried to basically pigeonhole you, put a square peg in a round hole, where it really should not have been that sort of concept. So that's at least the income play, with retirement annuity with an income play. What exactly do I mean regarding an accumulation play? And then I'll show you the examples. Now, the first type of accumulation play, I'm going to kind of discuss with you how a bank CD works, and then how a fixed annuity works, and then how a fixed index annuity works for an accumulation play off of what's essentially happened with interest rate environments and different things like that. And then where the accumulation on annuities are absolutely horrible, you definitely don't want to go that route, and maybe it might make more sense to just do more of a type of managed money approach, or different sorts of investments that are taking on a little bit larger risk. So what used to happen when you had interest rates were in double-digit figures, you would have like a main portion or main strategy for retirement income planning would be by leveraging bank CDs and fixed annuities. And the way on how it worked is like a bank CD, a certificate of deposit, has to be offered through a bank. An annuity has to be offered through an insurance company. A bank can't offer an annuity. If you're getting an annuity from a bank, they're utilizing some sort of insurance company with it. So, understand that those are separate. They have different legal reserve structures, different things like that. Let's say if you were, purchasing a bank CD back in the day, and let's say that bank CD was for 5 years, and it was giving you a 10% rate of return per year. If somebody went and had $1 million and they purchased a bank CD for those 5 years, they understand that the first year they would get $100,000 of interest. The second year they get $100,000 of interest. Third year they get $100,000 of interest. So basically after the 5 years, they'd be able to take their $1 million and reinvest that into a new 5-year bank CD. Or you could just kind of splice it up into 1 year, 2 year, 3 year, 4 year, 5 year. It was known as a type of a CD laddering strategy. So after those 5 years, when interest rates were really high, they would be able to take their principal, and all they had to do was just live off that interest year by year by year. There was no downward market losses. There was no fees other than sort of surrender penalties involved with that. And it was really easy on that retirement income playing field. So fixed annuities came out, and they said, okay, well, they have really large insurance companies with very large legal reserve structures in there, and really large safety in there. So rather than go with a 5-year bank CD that's paying 10%, an individual might go with a 5-year fixed annuity that was paying 13%. So therefore, it's giving you a safe income play, a safe type of account play, a safe accumulation play, but it was giving you about 2 to 3% higher guaranteed income at that point in time with that, with that 5-year interval, or that 7-year interval, or that 3-year interval, whatever that is. So an individual will go into a fixed annuity over a bank CD because they want to still have safety onto their account, safety from downward market losses, safety from fees, but just live off that interest year by year. Slight difference between a bank CD and a fixed annuity is the interest that gets paid on a bank CD is simple interest. So each year you're getting 1099 off of the income that you're making if it was, let's say, in a regular non-qualified account. So you would be getting, in this case, if you got 10% that was getting paid on the 5-year bank CD, it would be $100,000 each and every year getting dropped into the bucket. if you had a fixed annuity that was paying 10%, well, what it's doing is utilizing the power of compound interest. So after the first year, if you had $1 million, your account value starting year 2 would be 1.1 million, and now you have 10% off of 1.1 million, then 10% off of that number, 10% off of that number. So it's not just a flat $100,000 each and every time. So there's differences between simple interest and compound interest. So like right now, unfortunately, the downside to these types of fixed accounts are what has occurred with interest rate environment. So when an individual needed 100,000 or was trying to get 10% on their monies off of a really fixed safe contract, now that same sort of contract on a 5-year bank CD is paying 1%, 1.5%, maybe 2% sometimes. So therefore, it's a lot lower, and individuals have to take on larger risk, or they have to leverage different strategies to receive that type of income play. Because if you threw $1 million at a 2% bank CD, you're only getting 20 grand. If your income goal was 50,000, you're falling short by 30,000. So many times if somebody's looking for an accumulation strategy and they say, okay, they want to get a little bit higher interest, well, you have some of the top fixed annuities, like 5-year fixed annuities, that are paying like 3.25% or 3%. So it's about a percentage, 2% higher than what typical bank CDs are paying. So it's owned by an insurance company, being offered by an insurance company, as opposed to being offered by a bank. So that's the concept regarding a fixed annuity, coming from a bank CD to a fixed annuity, understanding that just like a bucket with the lid over it, you're receiving, if you were getting 3% interest rate each and every year, 3% is getting poured into that bucket, poured into that bucket, poured into that bucket, and you have the power of compound interest working on a good accumulation strategy. But it's very small interest credits, unfortunately, in today's interest rate environment. If interest rates increase, and then you're going to see a trickle-down effect, regarding the fixed annuity landscape, regarding the bank CD landscape, all those different things. So, but understand that after each year, you're getting 3% in this example. If the market goes down, you get 3%. If the market goes up, you get 3%. So when the interest rate environment started going down, individuals said, well, I want to at least beat out the pace of inflation. If inflation is increasing between 2 to 4% in a given year, that's the cost of goods and services, basically purchasing power risk. The value of your dollar is decreasing by this invisible 2 to 4% in a given year. Individuals want something that's going to at least double that, or at least, beat out that pace of inflation. And because if, let's say, you're getting a fixed interest rate, or you're not getting any interest rate on your money, you're just getting 0%, and you're just leaving it in a checking account or a savings account that's barely paying you anything, you're going to get beat with this purchasing power risk each and every year on an inflationary basis, on an accumulation basis. So something that could combat that. And this is where you have a lot of these indexing strategies came out. They originally came out in the 1990s, and since that point in time, they've actually gotten a lot better because individuals have really gravitated towards that concept. And you have some insurance companies that still have crappy accumulated fixed index annuity products, and you have ones that are pretty good for an individual situation. The trick with an indexed annuity, I'm going to clear off the screen, is to understand it's not the same as an investment. You're not having these astronomical gains in a given year. It's just meant for the individual that wants to have safety and consistent accumulation onto their accounts, and also have that tax deferral within their growth, the power of compound interest. So what a fixed index annuity could do is, if you kind of think of your money like a bucket with the lid over it, what it's saying is your principal, and these are ones, FIAs without the income rider. Income rider was what I mentioned before with the income annuities. But just a regular FIA that doesn't have any fees, what this is showing us is, let's say if you have an FIA that's it's utilizing an S&P 500 with a 10% cap, as an easy hypothetical example. What this says is if this index, let's say, and you had a 5-year fixed index annuity that was doing this, and let's say that the index gains 15% the first year, then it loses 30% the next year, then it gains 5% the next year, then it loses 15%, then it gains 11%. What exactly was the growth within this account? Well, the first year when the index gained 15%, if your cap is at 10%, it gives you these fixed index annuities. They'll give you up to a specific cap limit or a specific threshold with a floor of 0%. So what this says is after the first year, if it gained 15 but our cap was 10, you're going to have a plus 10% into your bucket. The next year when it lost 30, you're going to have a plus 0% to that bucket. The next year we're going to gain 5. Well, 5 is underneath the cap, so therefore you're going to gain 5%. The next year it lost 15, you're going to gain 0. And then the next year it gained 11, which is above our cap of 10, so you're only going to get whatever the cap is. So what this shows us is you would have had a plus 25% gain, or about 5% per year for those 5 years, which would have been better than, it would have made more mathematical sense to go into that FIA because it gave you a 5% average rate of return per year as opposed to a 3% rate of return that was on the fixed side. So it's allowing you to beat out the pace of inflation, still reducing that downward market losses, so you're not susceptible to those downward market losses, but it's gaining whenever the market goes up, doesn't lose whenever the market goes down. So with some of the best ones out there currently with the interest rate environment, you can expect anywhere from about a 2-3% low average rate of return to as high as a 6-7-8% average rate of return with some of the best carriers. So it's not something that you're getting these double-digit rates of return, which you can in given years, but on average, this is, you're looking to have that safety and that consistency with that type of account and avoiding those types of fees. So once again, when somebody is susceptible to a really crappy product, what they'll usually do is if they're looking for a retirement annuity and they're utilizing an accumulation strategy and there's thousands of combinations available, they might get pigeonholed into the wrong product. Like a fixed annuity. If the top fixed annuity is paying 3.25% for a 5-year, why would you put your monies into a fixed annuity that's only paying 2% for a 5-year? Doesn't make any sense. If you have the same sorts of safeties, if you have a good rated carrier, different things, it makes more mathematical sense to go with the higher rate. Just like with the FIAs, if you have something that has an S&P 500 with a 10% cap, or another one that has an S&P 500 with a 3% cap, why would you go into the one with the 3% cap if you could leverage your dollars a lot better with the best carriers? So it really just depends upon what your age is. It depends upon your state, depends upon the different offerings, what your goals are, and that's essentially where we're able to cherry pick the different strategies and the different product lines to say, okay, how can it match up like a perfect puzzle piece? How could we segment them to specific lanes? So as an example, like I mentioned in the very beginning of this video, I want to show you 2 examples. One where annuities can work really well, and others where annuities are complete disasters and you really probably shouldn't look at an annuity at all. And let's say if we have an individual that's age 60 that wants to retire at age 65. Let's say you have a single individual age 60 wants to retire at age 65, and let's say that they have $500,000 that's currently sitting in their 401k account or old 401k, old retirement accounts. So they're saying they're going to still be working for these next 5 years. They want to retire at age 65, and they want this to last them to the rest of their life. And let's say this person thinks they're going to live till age 95, whatever that, or age 100, whatever that is. With this situation, if this person has these monies in an old 401k or an IRA, and these are qualified retirement accounts, we have to figure out, first off, what exactly are their expenses currently, and what are their expenses going to be at age 65. So it's all throughout. Whenever somebody is gearing up for retirement or they're currently retired, in order for them to confidently retire forever, they have to make sure 3 things are covered. They have to make sure they have ample amount of income sources. They have to make sure that they have ample amount of emergency funds. And they also want to have some sort of strategy to combat a sort of inflationary risk. So with this person's situation, let's say we understand that they need exactly $50,000. That's going to be their expenses from ages 65 going forward to the date of death. So what are we going to look at first? Their income sources. Does this person have any pension money? Does this person, what are they going to be receiving at Social Security income? What are their other retirement assets? We understand their retirement assets are $500,000. Let's say if they are getting a pension plan for $10,000 a year and they're receiving Social Security income for $30,000 a year. Well, this tells us is that they're already receiving guaranteed income sources of $40,000. The gap is $10,000. So rather than go and take the $500,000 and throw it all into an annuity, that does not make sense. What do we want to do? We want to utilize the insurance product to ensure that they're going to be receiving whatever the gap is. So that is, in this situation, this hypothetical situation, their gap is $10,000. They have $500,000. So maybe what the best contract is when we're going through the thousands of different combinations is it might say, okay, Company A is, going to say, if you provide Company A 100 grand at age 60, they're going to give you $10,000 by the time it hits age 65 of lifetime income each and every year to the day that person passes away. If this person lives to 120 years old, that $10,000 is still going to be on the hook. Let's say if this person passes away within a couple of years, whatever they did not pull from, that's what's going to be left over to that person's beneficiaries. So it basically covers them on an income play to say, if they pass away, well, their money wasn't completely wasted like old-fashioned annuities used to provide. We're leveraging income riders and different things for a safety play. So Company A, if that's the best route for $100,000, don't go with Company B or Company C that might say, okay, with that same $10,000, you need to give $150,000 with Company B or $175,000 with Company C. You want to leave as much money in your pocket at the end of the day. So this is why, in this example, we'd go with Company A. $10,000. So therefore, the income sources are covered. Age 65, they know if they give $100,000 out of their $500,000, they're going to have $400,000 remaining. $100,000 went into IRA annuity contract number 1. It's going to suffice what their income goal is. Number 2, emergency funds. Rule of thumb is you want to have anywhere between 6 to 12 months of emergency funds available at a given moment's notice. So this is if somebody, you come to a medical ailment or tree comes falls to your house, whatever that is, you want to splurge, take a vacation, whatever that emergency might be. You want to at least make sure there's about 6 to 12 months of expenses, of annual expenses, in at least a type of savings account. So maybe with that, out of this $400,000 remaining, you want to throw $50,000 into like an IRA money market account. Something that's not going to gain, it's not going to lose, something that's just completely liquid that you could pull from in case of that emergency. So now this says that if we reduce this 50 grand, now we have $350,000 to work on that inflationary need. So this is where you could do a combination of things. You could still stick with that strategy of investing your monies and trying to throw into the stock market and bonds and commodities and real estate and do managed money concepts, different things like that. You could set up different annuity laddering strategies that say, okay, maybe at age 65 it's going to be $50,000 of income I need, but maybe by the time I'm 68 years old, my expenses are going to increase to $52,000, so therefore I need to trigger another $2,000 of income. So I'll take a small portion of this and put that into another annuity that's not deferring for 5 years, but maybe deferring for 8 years, and triggering that. So you're stepping up with that income to combat that inflation. You could also leverage the accumulation strategies of saying, okay, well, I don't want to leave this money susceptible to downward market losses, so maybe I might take $100,000 and throw it into a fixed annuity, another $100,000 throw it into a fixed index annuity, have another, the remaining $150,000 and throw that into investments. So there's a whole slew of combination of different things, but rather than guess and shoot from the hip and fall victim to reverse dollar cost averaging, what we're doing is we're creating an actual plan. We're creating a type of puzzle that is going to mold perfectly for their situation. And the largest takeaway is you don't have to throw thousands and thousands of dollars into an annuity. You only have to throw what's necessary. As an example, if we have that individual that's 60 years old and wants to retire at age 65, and they have $500,000 that's sitting in retirement monies, and they're trying to plan it out, and we understand that they have expenses of $50,000, and we're looking at our three-legged stool of income, emergency, and inflation. Well, at this point in time, what happens if their pension income is $40,000 and they have Social Security income of $30,000? Well, they're already at $70,000 of income, of guaranteed income, and their goal is $50,000. So why would you go and take $500,000 and try to put it into an income-based annuity, a retirement income annuity, if there's no reason to receive that much more monies? And that's where you see a lot of like income riders. They'll talk about like a 7% guarantee or a 10% guarantee, and that is nothing more than a calculation account. It's not true value of your money. So do not get duped into different income riders and fees and paying unnecessary fees for these types of things. With this situation, well, you could still leave $50,000 aside as an emergency fund. So now you have $450,000 to play with, that you could still stay with your investment strategy. You could, leverage the different possible, accumulation strategies off of the safer type annuities. But, for the most part, you don't have to stress as much because your income goal is already met. And maybe your pension plan also has inflationary step up, or you might be fine with just stepping up with whatever the Social Security inflation increases are going to be. So, this is a situation where an annuity would really not be beneficial for an individual situation. And, and this is something to just be mindful of whenever you're looking towards an annuity route to help you for your retirement. So in closing, if you found value in this video, please feel free to call our 1-800 number. It's 1-800-566-1002. We offer 24/7 customer service. We're available mornings, nights, weekends, holidays, whatever the case might be. And you can simply give us a call, and then you basically talk about your situation. You say, hey, listen, I was watching a video online. I was interested in an annuity. I want to speak with a specialist. And then depend upon, whichever specialist is available at that time, we'll give you a call back. And we'll make sure to see what your situation is, where your current point A is, what is your situation, what do you want to accomplish, and then how to accomplish from point B going forward to the rest of your life. So if it's an accumulation play, how exactly can you be most efficient, most effective? If it's an income play, how exactly can you be most efficient, most effective? And this is what we're trying to do is with educational pieces, we try to send you literature pieces, personalized videos, different things to help you get acclimated rather than, pay an advisor a fee and just, hope that everything that he's telling you is correct. We want you to be part of the process. And, we've been doing this for many years now. We're A+ rated on the Better Business Bureau. We've had very good reviews. We've never had any complaints. I believe it's because of this methodical process. A more efficient way on how you could set up an appointment with us is through our digital calendar on our website. And our little website link is going to be, attached at the bottom in the description of this video. But it's a retiresharp with a p.com or a fossefinancial.com, and it's all going to bring you to the same place. All gets aggregated to the fossefinancial.com, but you're going to see this little icon that pops up on the bottom right hand side. It says book your strategy session. So essentially go down over here, click the appointment schedule, or schedule appointment, and then so we'll make sure just kind of put your information, see which time works out best, and then write down a little note to say this is exactly what I'm interested in. We'll make sure that we'll match up the best specialist to give you a call at that time and to try to help you out best way possible and most efficient with your schedule. So once again, thank you very much for watching this video. Please feel free to subscribe to our YouTube channel Retire Sharp so you could have access to the most updated videos. Thanks so much, guys.